All right, Matt Smith here with Bradford Ferguson. We're going to talk about covered calls. We are advocates for covered calls for a lot of our Rebellionaire clients. And if you were selling covered calls last week, chances are you were in a bit of pain and potentially a little bit of emotional distress dealing with the massive spike that Tesla had. Anytime Tesla does spike and you're selling covered calls, it can be a tricky situation. And so we wanted to kind of go through why we advocate for this strategy, even though we know that we are going to have weeks like last week where things get a little bit uncomfortable. I've seen a lot of folks on Twitter basically saying, oh, like selling covered calls is just risky and you risk permanently losing your shares. And this is why you should never sell covered calls. A lot of stuff that I think is just common misconceptions, actually. And it's not to say that there's not tough weeks, there very clearly are. But want to say why, even with the acknowledgement that there are some weeks where it goes against you in a pretty drastic way, we still think the strategy makes a lot of sense overall.
Yeah, so we base our strategy based off of research. So we looked at the history of Tesla stock options, and one of the big criticisms that people say is that you're collecting pennies in front of a steamroller. That it's a dumb thing to do, and people worry that they'll lose their shares when the stock revalues higher. So what we want to show you today is how a covered call strategy did in 2020. Past performance is no guarantee of future results. This doesn't mean it'll repeat, but in 2020, the stock was up 730% for the full year. And it's like a nightmare scenario for covered calls. And what we found was that there was actually a sweet spot that you actually gain shares by adding a consistent covered call strategy throughout the year. So instead of stopping it as soon as it doesn't work, we pretended during the year that you kept doing it throughout the year. So Matt's going to share his spreadsheet and we'll get into it.
So as Bradford said, we actually pulled a lot of data. I mean, this is a summary sheet, but there was a massive amount of work that went into actually pulling all the raw data that went into making this a bit intelligible. But what we did was actually check the strategy.
I actually used ChatGPT to help me code.
It was pretty wild. I mean, over 200 million rows of data, just kind of crazy amounts of analysis that went into this. And we do think this is pretty unique analysis. We've shared this with clients before, but this is the first time we're actually sharing a snippet of it publicly. But what we actually found is if you choose a sufficiently out of the money call option, which has really informed our current strategy that we're following, and you essentially are following this strategy every week. So what we have here is choosing a 21% out of the money call option on a weekly basis, selling it at Monday at the open and closing it out on Friday. And you just follow this consistently on a portfolio of 10,000 shares. You are, as Bradford said, collecting pennies for the most part, at least early on here. But as Tesla rallies and the volatility of the weekly returns starts to pick up, you can see that the premium starts to pick up. We had this week here in April of 2020 where Tesla rallied 29%, and that resulted in losing around 4% of this hypothetical portfolio's shares. So this is, I think, another misconception. I think a lot of people have this idea in their mind that if Tesla rallies 30% and you sold the 20% out of the money calls, like you're going to lose half your shares or something like absolutely catastrophic. But when you actually do the math on the closeout costs and acknowledging the fact that your shares actually participate in the upside up to the strike price that you choose, and you actually do the math of unwinding the entire position, you do lose shares, but it is, I think, not quite as many shares as a percentage of the portfolio as many people might think.
This is all split adjusted. So yeah. The options prices are split adjusted. The stock price is split adjusted. Yeah, and it's running a portfolio that's not 100% just stock and options. It has some cash. So when it gets cash from the options premiums, it buys more shares, and when it gets enough for at least 100 shares, it'll buy them in 100 share increments. And then when it loses shares, it subtracts shares and cash.
Yep. Yep. And so this is just a summary. There's a lot more analysis that kind of goes into these summary numbers. But just to kind of give you an idea of how the strategy would work at a high level, we've really simplified this here. And so then you can see just a couple weeks later, there's another week where you'd lose about 2% of your shares after Tesla rallied 26% in that particular week. But then you see premiums start to really spike again. I mean, in the Q2 earnings week, which is actually analogous to the week we're about to enter next week, premium just kind of goes crazy, getting $2.54 of premium at a time when the stock was $117 per share. So that's really phenomenal amount of premium that you can get for just a 1 week period of time. And you can see the stock actually dropped during that time. So it would have been a very good time to be selling covered calls.
Yeah, let's back up a sec. So May 1st, 73 cents. May 1st was not an event week. So like to see 73 cents as the premium there, that was like people FOMOing into Tesla. And it's pretty volatile time with what was going on in the world then. So it's very important to highlight, like when you have these losing weeks, maybe you didn't sell the premium that great, but if you keep doing it, the premium you get for the next few weeks is higher.
Yeah. And that's certainly what we're seeing right now as we're looking at covered calls for our own clients. And so you just kind of going through here, I mean, you can see there's periods where it kind of levels out again. And if you just kind of stick with the strategy, okay, maybe you're not making as much premium as you were hoping, but you do get these kind of big spikes, especially, I mean, you can see here, we have this massive spike where Tesla's up 26% in a week again. Stock, you'd lose a few more shares, but then you're getting a lot more premium in the subsequent weeks. So this kind of happens over and over again. But then you can see in the back half of the year, even though Tesla kind of continues rallying during this time, you're able to collect on premium so much so that you're adding to your total share count, and even recouping. So this portfolio started with 10,000 shares. And by September, you've actually recouped and then some your entire portfolio value, or your entire starting balance. So by the end of the year, you'd have another week where you lost 200 more shares. But by the end of the year, at least with this exercise, you'd end with 10,700 shares. So 700 more shares than you started, even though you got three pretty scary losing weeks where Tesla did rally. So just wanted to kind of share this research. It can be scary. It can be emotional, which is why we don't anticipate, or we don't really recommend doing it if you're the type of person that is prone to kind of make rash decisions. But a lot of what we're seeing right now is kind of I would say some FOMO and wanting to participate in the upside, and because Tesla's rallied so hard, we think it's going to continue rallying even higher from here. And if you look at even 2020, which was like the poster child of a year where that did happen more or less, it's not the type of thing where you've got a 29% rally followed by a 25% rally followed by like another 20. It's very unusual for rallies to kind of continue week to week at that level of magnitude. So while a lot of people are kind of naturally and understandably feeling some fear and anxiety and wanting to run away from this strategy, we think this is actually the time you want to be leaning into the strategy.
Perfect way to stop. And this is not investment advice. We are financial advisors. This is just what we're seeing and what makes sense to us based off of our research. And it's been good talking with you. We'll say bye for now.
Bye for now.